Well, welcome everyone to the Chartered Accountants Worldwide Network USA webinar, What's Happening with International Financial Reporting Standards, presented by BDO. My name is Jeff Aldridge. I am the president for the Chicago chapter of Chartered Accountants Network USA, and I'm also a corporate tax principal with BDO. Before we start today's webinar, we need to run through a little housekeeping. So first up, a handout is available. You can download this from the control panel for this event. Secondly, this webinar is CPE eligible if you have requested it. So to qualify, you will need to answer the polling questions we will be asking during the webinar. There are 5 polls during the webinar and a survey when you exit. You need to answer at least 3 polls to qualify and attend for at least 50 minutes. The format of this webinar is a 60-minute presentation, including this introduction. If you have any questions, please note them down in the Q&A tab on your control panel. We will also be recording the presentation and will make it available on the CAW Network USA website. At the end of the event, when you exit and take our short survey, do please let us know what you think. Plus, let us know if you want to connect with any of the presenters. Our learning objectives today are that after the presentation, you should be able to understand IFRS 19, subsidiaries without public accountability and the disclosures, IFRS 10, consolidated financial statements, control considerations, IFRS 15 versus ASC 606, key differences, and IAS 23, borrowing costs. Discussion of these areas will be followed by a wrap-up session and any audience Q&A. And now let me ask Andy to run our first poll. And while you are responding, I'd like to introduce our team. So as I mentioned earlier, I am a tax services principal at BDO. I focus on helping foreign and/or private equity-owned US companies with their US tax needs. Before I introduce the first of today's speakers, I also want to say just a couple of words about BDO. BDO is the 5th largest accounting firm in the world. We offer a full suite of tax assurance and advisory services from more than 60 offices across the US and over 160 countries worldwide. In the US, we are now also a proudly employee-owned business. Our presenters today are part of our global services group, specifically within our IFRS team. The team helps clients with conversions to IFRS, specific technical reporting issues, and general ongoing reporting, as well as supporting BDO's audit and assurance practice with reviews of IFRS review reports and opinions. They are also well connected with our global IFRS reporting team that has a wealth of resources and brings together our experience from around the world dealing with the practical application of IFRS, particularly with regard to implementing new standards. From that team, I am joined today by Andrew Moore, who is a professional practice director, Oscar Ayalo Murillo, who is also a professional practice director, Shane Klassen, who is a professional practice audit senior manager, Kishan Kumar, who is a professional practice audit associate director. And now let me ask Andy to close and share the results of the poll. Very good. And with that, I'll hand over to Oscar to talk about IFRS 19.
Thank you, Jeff. Appreciate it. All right, so let's now dive into IFRS 19 and understand the key concepts and requirements to apply the standard. And if you can move the slide. So in May of this year, 2024, the IASB issued IFRS 19. And this standard came to life because of certain subsidiaries that are required to report to a parent company using IFRS accounting standards where at the same time using IFRS for SMEs or other national or local GAAP. And as a result, being required to maintain two sets of financial records, sort of creating inherent inefficiency because of the subsidiary producing two sets of books, one for the parent's consolidation and one for its own financial statements. So IFRS 19 deals with those eligible subsidiaries reporting to a parent company to apply reduced disclosure requirements in its own financial statements, and while applying the recognition, measurement, and presentation requirements in IFRS accounting standards. So for a subsidiary to apply IFRS 19, it needs to meet certain requirements and may elect to apply IFRS 19 if in its consolidated financials, separate financials, or individual financial statements, but only if meets certain eligibility criteria. And that criteria is, first, the entity is a subsidiary as defined for Appendix A in IFRS 10. Secondly, the entity does not have public accountability. And third, that the entity has an ultimate or intermediate parent that produces consolidated financial statements that are available for public use that also complies with IFRS financial statement or IFRS accounting standards. So in order to meet that second criterion of not having public accountability, the entity should not have debt or equity instruments being traded in public market or in the process of issuing those instruments for trading in public markets, and also holding assets in a fiduciary capacity for a broad group of outsiders as its own primary business. Next slide. Now, one important point about IFRS 19 is that an intermediate parent company is also permitted to apply IFRS 19 so long it meets that eligible criteria that we just talked about. So like we see here the diagram on the slide, right? For example, out of the entities in the group that are subsidiaries, so take intermediate parent Y, subsidiary B, and subsidiary D, which are highlighted in the red boxes, have public accountability and therefore are not eligible to apply IFRS 19. Now, on the other hand, intermediate parent X, subsidiary A, and subsidiary C, which are highlighted in the green boxes, do not have public accountability. So as such, the ones that are highlighted in green are subsidiaries, and they have a ultimate or intermediate parent that produces consolidated financial statements that are available for public use that comply with IFRS financial accounting standards. So therefore, these entities are permitted to elect and apply IFRS 19. As I discussed, intermediate parent X in this example is permitted to make a separate election to apply IFRS 19 for either their separate financial statements or a consolidated financial statements. Now, in summary, looking at the diagram as an overall, if a group of entities is located in a jurisdiction where it is required to apply IFRS accounting standards, but then the ultimate or intermediate parent in the group are not publicly accountable and their financial statements are not available for public use, then the subsidiaries or intermediate parents will not be able to apply IFRS 19. Next slide. Now, if you were to look at the structure of IFRS 19, the disclosure requirements are organized into subsections related to IFRS accounting standards. So in essence, a subsidiary applying IFRS 19 will apply IFRS 19 accounting standard to a transaction for the purpose of the recognition, measurement, and presentation, and then apply those disclosure requirements set out under the subheading under that IFRS 19. So the main approach when IFRS 19 was developed was if the recognition and measurement requirements were the same in the IFRS for SMEs and the accounting standards and IFRS accounting standards, then the disclosure requirements in the IFRS for SMEs are to be followed. Now, on the other hand, if the recognition and measurements between the IFRS for SMEs and IFRS accounting standards, then the disclosures requirements in IFRS are to be followed, applying the principles used in IFRS for SMEs. Next slide. A few key matters that are important to mention are related to IFRS 19, and the standard does not provide reduced disclosures requirements for IFRS 8 for operating segments or IFRS 17 insurance contracts and IAS 33 earnings per share. Now, also, even though an entity applying IFRS 19 does not need to provide a disclosure if it's considered not material, the entity also is required to consider whether that providing additional disclosures when in compliance with the specific requirements of IFRS 19 is insufficient to enable users of financial statements to understand the effect of those transactions and other events and conditions that the entity's financial positions, financial performance. And we'll talk about that on our last slide. So let's bring this to life in the next slide to talk about or look at a few examples. So the example number one, which relates to a subsidiary that is applying IFRS accounting standard to a transaction for the purpose of the recognition, measurement, and presentation. So note that if the subsidiary is eligible and decide to apply the disclosure requirements set under the subheading under IFRS 19, the entity in this case will disregard the disclosure requirements set by the specific IFRS standard, in this case IFRS 2, paragraphs 44 to 52, and will then apply the reduced disclosures that are set by IFRS 19, paragraphs 31 and 34. Now, let's talk about a transition requirement. And IFRS 19 provides this reduced disclosure requirements for IFRS 1, which is the first time adoption of IFRS reporting standards. However, electing or revoking an election to apply IFRS 19 does not on its own result in an entity meeting that definition of a first-time adopter of IFRS. So for example, in the scenario that we have here, an example number 2, if an entity in year 1 applies IFRS, but not IFRS 19 in the financial statements for year 2, the entity will not have to apply IFRS 1 and will provide disclosures required by IFRS 19, including for comparative information. However, if the company had applied IFRS for SMEs in year 1, then the financial statements for year 2 will have to apply IFRS 1 and would also provide the disclosures requirements for IFRS 19, including for comparative information. Next slide. Now, to sort of wrap up IFRS 19 and what I talked about before, let's discuss those with clients or registrants that file documents with the SEC that will relate to a merger with a business that ultimately will result in a subsidiary that qualifies for or elects to apply for IFRS 19, and where the registrant is also required to provide financial statements of the acquired business under Rule 305 of Regulation SX. So the acquired business or subsidiary is required to, by IFRS 19, to consider whether additional material disclosures need to be included in its own financial statements to enable those investors to understand the impact of the transactions, other events, and conditions of the business financial positions and financial performance. So, given the purpose of inclusion of the acquired business financial statements in a registration statement, that needs or the needs of investors will likely be similar to the needs of investors in an entity with public accountability. So in that scenario, even though the acquired business may be eligible to has elected to apply IFRS 19 in order to benefit from those reduced disclosures, as we talked about, it should also carefully consider whether it nevertheless required to include additional material disclosures from other IFRS accounting standards and achieve those objectives of financial reporting, given the fact that those financial statements will be filed with the SEC. And last but not least, this IFRS 19 is effective for reporting periods beginning on or after January 1st, 2027, although early application is permitted. And with that, turn over the presentation to Andy. Thank you, appreciate it.
Okay, we're going to run a quick poll here. Okay, I'm going to close that up. Share the results. Everyone got that one right. Okay, so next up we're going to look at IFRS 10 and spend some time on consolidation and control. So we want to talk about this today as there's been a number of cases recently where we've analysed issues around control and tight determinations of whether an entity should consolidate their investments or recognise it as an equity method investment. Today we're going to focus on the control requirements and some examples kind of focused around that. In practice, we often also need to consider the guidance in IFRS 11 and IAS 28 when making an overall assessment in a particular scenario. Just to give you a little background though, first on IFRS 10, in May of 2021, the IASB published a package of 5 standards, which they called the consolidation package, which set out the requirements for consolidation around consolidation, joint arrangements, and disclosures of interest in other entities. So this was IFRS 10, IFRS 11, joint arrangements, and IFRS 12, disclosures of interest in other entities. And in addition, there were some revisions to IAS 27, which is the separate financial statement standard, and IAS 28, so that's the investment in associates one. So that was a big, it's a while ago now, but it was a big change for sure. So IFRS 10 applies to all entities that control one or more entities. So however, there is an exception to consolidating particular subsidiaries of an investment entity or certain scenarios where a parent company produces publicly available financial statements, which we're not going to go into today, but want to bear in mind if there's potential there for an exemption or where you would need to apply this. So IFRS 10 has a single control model. An investor has to be all of the following. It has to have all of the following qualities in their investment in order to be able to consolidate an entity. So it's got to have a power over an investee. It also has to have exposure or rights to variable returns from its involvement with the investee. And then finally, it needs to have the ability to use that power to affect the amounts of the investor's return. So there's been a handful of small amendments to the standard since its initial effective date. But in 2022, the IASB actually did a post-implementation review and determined that the standards were meeting their objectives. So IFRS 10 requires a parent to prepare consolidated financial statements when they have control. So control is defined as we discussed on the previous slide with reference to the power over an investee, whether it's exposed to variable returns, and whether it's able to use those two in combination for their benefit. So consolidated financial statements are defined as the financial statements of a group in which the assets, liabilities, equity, income and expenses, and cash flows of the parent and its subsidiaries are presented as if it's a single economic entity. So familiar concepts, hopefully, to most of you. So as I said, all 3 criteria must be met. And we've just kind of got like a little, the slide includes a nice kind of visual way of presenting this information that's helpful. So IFRS 10 in the paragraph B3 notes some additional factors that may come into the determination. So you need to think about the purpose and design of the investee, what the relevant activities are, and how those activities are made. And that is a really key one that we'll expand on in a minute. Whether the rights of the investor give it the current ability to direct those relevant activities, and also whether the investor has the ability to use its power over the investee to affect the amount of the returns. So IFRS 10 contains an explicit requirement for the investor-investee relationship to be reassessed on a continuous basis. So if you've got changes to agreements or percentage of shares or even board composition, it's definitely something that needs to be constantly monitored for changes, especially in close call situations. So as discussed in the previous slide, relevant activities is a key one. And the relevant activities really depend on the business model of an investee and how the revenue is generated. Investees will usually have a range of operating and financing activities that significantly affect their return. So in IFRS 10, paragraph B11, there are some specific examples of relevant activities. So that could be selling and purchasing of goods or services, managing financial assets during their life. Also, maybe if there's a significant role in selecting or acquiring or disposing of assets, and also the extent to which there's influence over the funding structure or the obtaining funding. And then in IFRS 10, B12, they talk about examples of the decisions that could affect the relevant activities. So who's responsible for establishing the operating and capital decisions of the investee? So the budget especially is one you have to go look carefully for in the agreements to see who drives that. And then appointing and remunerating the key management personnel is also a key one, as well as the board composition. So if just one of the directors has the ability to direct, then usually they're the ones that we see to have consolidation. So in addition, care is going to be required in circumstances where two or more investors appear to share control, and therefore we need to look at some other standards and bring those in, IFRS 11 specifically. So an investor has power over an investee if it has existing rights that give it the current ability to direct the relevant activities. Only substantive rights are considered, with protective rights being disregarded. So the fact that an investor directs the relevant activities is an indicator that the investor has power, but it's not necessarily conclusive. So for example, another party might have power over the investee, but choose for whatever reason not to make use of that. So just to get our definitions in, the protective rights are defined as rights designed to protect the interest of the party holding those rights without giving that party power over the investee to which those rights relate. So an investor that only holds protective rights, which meet the definition, has no power over an investee and consequently does not control the investee. So the standard follows the logic that protective rights are designed to protect the interests of the holder without giving it power over the investee, and therefore it cannot prevent another party from having power over an investee. So protective rights relate to fundamental changes to the activities of an investee, or only apply in exceptional circumstances. The fact that a right only arises in exceptional circumstances is not in itself conclusive that it's a protective right, though. So definitely an area to be careful about as you go through and analyse the details of the agreements. So some examples of protective rights is provided in B28 of the standard. So, for example, a lender that has a right to restrict borrowers' activities if these could change the credit risk or significantly be to the detriment of the lender. Another one might be a capital expenditure greater than required in the ordinary course of business, requiring approval by non-controlling interests. So these are protected, but they're not necessarily controlling rights. Also, issue of debt or equity instruments requiring approval of non-controlling interest holders. So they have some influence, but they're not potentially not decisive ones. To link up a couple of the current concepts here, I wanted to bring in an old IFRS Interpretation Committee agenda decision in respect of a question concerning whether an assessment of control should be reassessed when the facts of the circumstances change, where rights which previously were determined to be protective change. So in this IFRIC agenda decision, the example discussed was in the case of a breach of a covenant in a borrowing arrangement that causes a borrower to default, triggering the ability of the debt holder to exercise rights that previously would have been determined to be protective in nature. So when this went through the IFRIC committee, they concluded that IFRS 10 paragraph 8 requires an investor to reassess whether it controls an investee if facts and circumstances indicate that there are changes to one or more of the three elements of control. So as I said, so if something's changed around the power, exposure to variable returns, or the linkage of power and returns. So you'd have to go through again, if something like that changes, you'd need to go through and assess it through that lens to see whether there's been a change of control. So let's revert back to substantive rights. So IFRS 10 acknowledges that the assessment of whether rights are substantive requires judgment. It provides examples of factors that need to be considered, split into these three headings that we got in the table here. So barriers to exercise, agreement of other parties being required, and then exercising benefits of the right holder. So what are barriers to exercise? They could be financial penalties or incentives, an exercise or conversion price that creates a financial barrier. A good practical example of this would be where the exercise price of options that give the holder sufficient voting rights to obtain control of an entity are deeply out of the money, and therefore it's uneconomic to exercise those rights. In that case, they'd not be factored into the assessment, or the importance of that feature will be minimised in the overall risk assessment. Terms and conditions, another barrier to exercise would be if you've got terms or conditions that make it unlikely that the right that the right is exercised. So, for example, a condition that lets a very narrow limit to the timing of an exercise, maybe a few hours or a day. And also, if you've got legal or regulatory requirements, so for example, are foreign investors prohibited from exercising certain rights, that could also, be a barrier to exercising a right. Another one would be where, so then switching into the agreement of other parties column. So when exercising a right requires the agreement of more than one party, the following factors should also be considered. Whether a mechanism is in place that provides the parties with the practical ability to exercise the right. So the absence of such a mechanism would indicate that the rights may not be substantive. Also, another one to consider would be the number of parties that agree to the exercise of those rights. The more parties that are required to agree to the exercise of the rights, the less likely it is that those are substantive. So then the other thing to think about in the other column on this table is around the exercising the benefits of the right holder. There's a further question of whether the party holding the right would actually benefit from its exercise in any case. So for example, potential voting rights. The terms and conditions are more likely to be substantive when the instrument is in the money or the holder would benefit in other ways. So for example, if there was some kind of synergies they were going to benefit from. So substantive rights really is it's an important one to consider as you're going through the analysis of the terms in the agreement, especially where you've got multiple owners with different proportions of ownership. So briefly on voting rights, an investor is required to consolidate an investee if it holds more than 50% of the voting rights through shares. This is a most common consolidation scenario. So this assumes that decisions about relevant activities are determined by the majority vote. So the threshold could be different. So for example, if you've got a 75% majority being required for some key decisions, you may have different dynamics within there that could affect the assessment. So the rights either need to, so when you're looking at percentage of rights and voters voting rights, you need to look at whether it's shareholders that drive that or whether it's board members. And so that's definitely a key concept, and seeing who has influence over the board members or who owns the shares. So IFRS 10 notes that an investor can have power even if it holds less than a majority of the voting rights. And then B38 of the standard includes some specific scenarios, which might be if you've got contractual agreements with other vote holders that gives you the ability to control, de facto control, or potential voting rights, or some kind of combination of the above. I'm not going to go too deeper dive into these for the purpose of the presentation, but if you're interested, you can find out more about these in the BDO IFRS 10 in practice guide, and we've got a link to that in the final slide of this deck. So we spent some time looking at how power can be exercised and demonstrated. So now going back to that original formula, let's look at the exposure to variable returns. So returns are variable if they're not fixed and they have the potential to vary as a result of the performance of the investee. So these results could be positive or negative or both. So variable returns of an arrangement are assessed widely. They're not simply on the basis of the legal form. So this can result in returns that appear initially to be fixed, but they are considered to be variable for the purposes of IFRS 10. So IFRS 10 B57 provides a list of many examples of variable returns, things such as dividends, interest from debt securities, changes in the value of the investee, and then sometimes you get like fees if you've got funds. You may have fees that vary based depending on performance. And also, there's also needs to be consideration around rights in the event of liquidation as well. Okay, finally, for the purpose of assessing control, we must assess the link between power and variable returns. So this criterion is included in the standard to address principal and agent relationships. IFRS 10 does not provide other examples where there's a link between power and variable returns. Sorry, where there's no link between power and variable returns. An investor with decision-making rights is required to assess whether it has the ability to use those rights to affect the investee's returns. An investor will be considered a principal if the investor is able to use its rights to influence those returns. This means that the investor is required to consolidate the investee because they meet all three criteria. An agent will not be able to consolidate the investee in this case because an agent does not meet the third criteria. This is because an agent is primarily engaged to act on behalf and for the benefit of other parties. And that's one we often see in investment funds and situations where you've got in private equity investments. Okay, so let's walk through a couple of simple examples. There's some more complex examples if you want that and if they're more applicable to you. Again, in the IFRS 10 publication that I referenced, we've got links to that in the slide deck. So let's look at case number one. So Wisdom LLC acquired 75% of the common stock of Saya during 2023. Saya's board of directors comprises 4 board members. Following the deal, Wisdom is able to appoint 3 of those board members. So in this example, we've got alignment there with the percentage of ownership. So decisions are made by the board based on the majority of votes. The board's responsible for the approval of the annual budgets, which, remember, thinking back, that those were related to the relevant activities. And they're also able to appoint key personnel who run the day-to-day operations, deliver sales and monitor costs. So common stockholders are paid dividends based on the proportion of units held. And the question is whether Wisdom controls Saya for accounting purposes. And for the reasons I just went through, so yes, they have power over the board seats. They have majority share ownership. They receive variable returns through their dividends. And they have the power to affect the variable returns via their board seat and the influence that they have there. So in this example, this would be a subsidiary. You would have an investment in a subsidiary that you would account for as you would be consolidating for. So let's look at case number 2. So Atlantic Boats acquired 50% of the common stock of Pacific Boats Limited. The relevant activities of Pacific are controlled via the board of directors. There are 5 seats on the board this time. As part of the agreement to acquire an entity, to acquire the equity interest in Atlantic Boats, they negotiated the ability to appoint 4 of the board directors. Again, common stockholders are paid based on proportion of your units held. So again, who has control of Pacific Boats for accounting purposes? So Atlantic Boats do have control here. So although they only have 50% of the common stock, they clearly have more control of the board by having 4 of the 5 board seats, and then the board has control over the relevant activities, and therefore they're able to assess whether they have, affect whether this proportion of their returns because of their ability to influence those items. Okay, just take a brief look at disclosures. So IFRS 12 is the standard that we go to for the disclosure element of these consolidated financial statements. So the objective of IFRS 12 is to require a reporting entity to disclose information that helps users of the financial statements understand the nature of and the risks associated with its interest in other entities. So whether that's subsidiaries, joint ventures, or associates as well. So the effect, and it also wants IFRS 12's objective is also to help users see the effects of those interests on the reporting entity's financial position, financial performance, and cash flows. So in our scenario, for investees that are consolidated under IFRS 10, the disclosure requirements under IFRS 12 are to include information about significant judgments and assumptions, and any changes in those assumptions as we go through. So things like this, to address this, we might include why it does not control another entity, even though it holds more than half of the voting rights, if that's the case. You might also include disclosure around why it controls another entity in a scenario where it holds less than 50% of the voting rights or the equity, which is what you might see in a normal disclosure. Where you've got non-controlling interests in the group's activities and cash flows for your subsidiaries, you're going to have to disclose the name of the non-controlling interest, the principal place of business, the proportion of ownership interests that are held by non-controlling interests, the profit or loss that gets allocated to that non-controlling interest during the reporting period, and then some summarized financial information about that subsidiary. If you wanted to see an example of the non-controlling interest disclosure, we do have that in our BDO illustrative IFRS financial statements, and there should be links for that later, or links to the BDO IFRS resources page. You also want to disclose your significant restrictions, such as like statutory, contractual, and regulatory constrictions that might affect the entity's ability to control the group. And then if you've got a disposal, any gain or loss on that disposal of subsidiary during the reporting period. Okay, so on this slide, this is the slide that I mentioned with the links to the IFRS 10 publication. Yeah, it's really helpful. It has a lot of good examples, very hands-on, some video comments to provide some insight from our global team. Highly recommended if you've got to go through the assessment. Okay, so now we're done with IFRS 10. Let's just run a quick poll. So what the question is, in IFRS 10, examples of variable returns include dividends and interest for debt securities. So sharing the results of the poll, 95% of you are right. Yes, both of those dividends and interest from debt securities can be seen as variable returns. Okay, and with that, I'm going to hand over to Kishan.
Thank you, Andy. Hi, everyone. My name is Kishan Kumar, and I'll be talking through IFRS 15, the IFRS accounting standards for revenue from contract with the customers. Revenue recognition has always been an accounting topic and an audit area in our practice. So let me advance with the slides here. Next slide, please, Andy. Okay, here's the content that we will be including in our topic today. Sequence 1, scope of IFRS 15 and ASC 606. Then we'll spend some time in the recap of 5-step models which we have for the revenue recognition. Lastly, we will talk through some of the key differences between ASC 606 and IFRS 15. Next slide, please. Okay, the scope of IFRS 15. The IFRS 15 revenue recognition guidance applies to all contracts with the customers from all industries, with certain specific transactions excluded. The examples are on our screen. Leases is the one of the most common example. So if you are in the business of investment properties and you are a lessor, that's how you generate your revenue from your customers. Well, then those contracts with those leases will be accounted for under IFRS 16 leases and not under IFRS 15. Similarly, for insurance contracts, if you are an insurer, that will be under IFRS 17, and so on and so forth. So just to highlight that IFRS 15 isn't necessarily applicable to every single revenue transactions. Oh, next slide, please, Andy. This is our 5-step model. So this is something that we have seen a countless number of times before, which outlines the core principle of IFRS 15. And that is for entities to recognize revenue in a manner that depicts the transfer of goods and services to customers, and in an amount that reflects the consideration to which the entity expects to entitle exchanges for those goods and services. So we have to observe that while these 5-step models at first glance can appear quite simple, within each of these steps, the standard helps us to consider the numerous complexities that arise in revenue arrangements. I would highlight examples of these additional considerations that companies are required to make under each steps. Step 1 is identify the contract. The step 1 requires us to determine the contract terms, who the parties to the contract are. It also requires us to assess whether the consideration is collectible and if there are any commercial substance to the contract. Moving to step 2, which is identifying separate performance obligations. Well, under step 2, we need to identify all the promises in the contract If there appear to be multiple promises, consider only those that are distinct of one another. And we also need to consideration to any immaterial performance obligation within the contract. The third step is the determination of transaction price. We need to estimate variable considerations, take into account any significant financing components, and then also identify and quantify any non-cash consideration that the contract has or any discounts that has been offered to the customer. The step 4 is kind of amalgamation of step 2 and step 3, which determines how the transaction price from step 3 should be allocated to the performance obligations, which were identified under step 2, and especially tricky when there are no absorbable standalone selling price of these performance obligations. The last step, which is recognized revenue, as and when the performance obligations are satisfied. This step requires us to assess whether performance obligations are satisfied over a period of time or in point of time. If it is over the period of time, we need to determine the most appropriate method to measure the progress. And if it's in point in time, we need to identify what that point in time is. So for example, it's a delivery of goods. We need to see whether it's FOB destination or the shipping point. Next slide, please, Andy. Okay, so now we are in the last segment of this content. Here we are going to talk about some of the key differences between IFRS 15 and in US GAAP, which is ASC 606. So fortunately, there are very few differences that has arise, and that is because this new revenue standard is a joint effort of FASB and IASB. But of course, there are few handful of differences where they disagree, and so the standard diverges slightly. We will be spending few minutes here, and we'll first start with the promised goods and services that are immaterial in the contract. So if we talk about ASC 606 first, entities are permitted not to assess whether the promised goods or services are performance obligation, and it is only if and only if they are material in the context of the contract. So it is very important to note here that in the context of the contract. On the other hand, IFRS doesn't have any specific reference to materiality at all in its IFRS 15 section. But however, IFRS does have materiality as an overreaching concept. And that would be in a kind of context of the financial statement. So that is at the financial statement level. The key difference here is ASC 606 kind of talks about the materiality in context of the contract, but IFRS 15 is kind of little pervasive, which is assessed at the level of financial statement. And this difference can give rise to different performance obligations identified in the contract with the customer. And then if we see IFRS, we basically might be able to identify more immaterial performance promises, which we are not concluding as a performance obligation because we are using a wider range of materiality. So in a nutshell, we could end up in a situation where we have different distinct performance obligations under both IFRS versus US GAAP. Next slide, please, Andy. So the next topic on the differences between IFRS and US GAAP is on how we are handling the shipping and handling activities. And shipping and handling activities specifically that occurs after the customer has obtained control. So 606 kind of provide entities as an accounting policy to account for these shipping and handling costs as an activity to fulfill the promise to transfer the goods, rather than just as an additional promise. So even though that these services are after the customer gets control, 606 even allows you to kind of bundle it with the promise to transfer that good, even though it has happened after onwards. But when we come to IFRS 15, it contains a general guidance for assessing whether various promises in the contract represent performance obligation. But there can be an instance where under IFRS, we end up with the shipping and handling services which is occurred after the customer has obtained the control being as a separate performance obligation with the later timing of revenue recognition compared to US GAAP if they actually adopt the accounting policy election. So yeah, these examples are quite nuanced, but such is the nature of these defined differences between these two standards. Next slide, please, Angie. So now we will be talking about accounting for sales taxes and how it is different in IFRS versus US GAAP. In IFRS, the IFRS 15 mandates the entity to exclude from the determination of transaction price any amounts collected on behalf of third party, and it also includes the sales taxes. So as a result, IFRS entities need to evaluate taxes that they collect in all jurisdictions to determine whether a tax is levied on the entity or on the customer. So it's a kind of applying the principal versus agent guidance. If the sales tax is a tax on the customer, then IFRS mandates that this is the amount to be excluded from the revenue because this is not the amount that belongs to you at all. It has always been collected on behalf of the jurisdiction. But when we come to 606, it actually permits an entity. It kind of gives an accounting policy election for them to exclude from the transaction price the sales tax that they collect from the customer. So because of this difference, the mandate in the IFRS 50 versus the accounting just permits in AC 606, there are instances we can arrive at a different revenue under 606 versus IFRS 15 because there's a different treatment of sales tax. So yeah, when we have sales tax, this is something we should definitely look out around. So now next we have measurement date for non-cash considerations. We have specific guidance in ASC 606, which talks about that measurement date for the non-cash consideration should be the contract inception date. And the variable consideration guidance should be applied only to the variability that is resulting other than the reason of the non-cash consideration. The big topic here is the measurement date, because in IFRS, on the other hand, it does not specify the measurement date for non-cash consideration. And so this can give rise to differences in valuation of the non-cash consideration out of these two accounting standards, because they are looking at different measurement date. So IFRS, under our judgment, might use the different date as of what ASC 606 suggests, which could give different valuation. So this is something definitely to look out when we see examples of non-cash considerations. Next slide, please, Andy. Okay, so this is one of the last differences that we are covering in this topic, and this is related to the measurement of contract assets acquired and contract liabilities assumed as part of the business combination. So under 606, the topic ASC 805 business combination specifically tells the entity to actually refer to topic 606 to measure contract assets acquired and contract liabilities in a business combination. So it precisely refers to 606 for its recognition. However, in IFRS, which is IFRS 3 business combination, it requires an entity to measure assets acquired and liabilities assumed in a business combination and its fair value on the date of acquisition itself. So under IFRS, there is no kind of arrow to point you to look at the revenue standards. It just says record them at fair value. And so that fair value will very likely, and there is a high possibility, would not be same as what would be determined under 606 or the revenue standards. And this can give rise to the differences in the measurement of these contract assets and contract liabilities in practice. So with that, we have the polling questions here. Next slide, please, Andy. So this is the polling question 4. IFRS 15, the 5-step model starts with step 1, identifying the contract. So the options are agree and disagree.
All right, I think up next. So hi everyone, this is Shane speaking. So I'm going to be having the pleasure of closing out today's webinar with just a brief refresher course on one of the most short and sweet IFRS accounting standards, which is IAS 23, the standard for borrowing costs. Obviously conscious of time, so over the next few minutes or so, we'll just remind ourselves of the fundamentals and then take a look at some of the differences between the treatment under US GAAP and IFRS. So as a reminder, what IAS 23 deals with is how to account for the debit side of borrowing costs. So very high level, What the standard tells us is that any borrowing costs which are directly attributable to acquiring or constructing a qualifying asset must be capitalized. All other borrowing costs should be expensed. Next slide, please. So next, let's take a look at some of the key terms that we need to know in order to understand how capitalizing borrowing costs works under IAS 23. So firstly, borrowing costs refers to any interest or other similar costs incurred by an entity in connection with the borrowing of funds. Note that this would include interest on bank overdrafts, interest on lease liabilities, and in certain situations, even foreign exchange losses on foreign borrowings. So it's quite broad under IFRS. Also want to just highlight here that the definition refers to interest incurred by an entity and not interest paid by an entity. So therefore, in situations where interest expense is not the same as interest paid, the interest expense is what is considered the borrowing costs. So for example, under the effective interest method, when there are adjustments upon initial recognition, such as fair value adjustments or debt issue costs, this would be an example where there's going to be a difference and you need to go with the expense incurred, not the amount paid. So just to flag that. Qualifying assets, that's another key term we need to know. So that refers to any assets that necessarily take a substantial period of time to get ready for use. Now, while the term substantial is not defined in the standard, in practice, we typically see this taken as being 12 months or more. So, that's what we typically see. It could certainly be justified as being less than that, but that's down to the judgment of the management. Next slide, please. So just delving a bit deeper into the borrowing cost definition, the standard describes two categories of borrowing costs, specific and general. Capitalization of each of these types of borrowing costs occurs in a very different manner, and so it really is critical to understand the difference between them. So let's start by looking at specific borrowing costs. As you can gather from the name, this is where funds are borrowed specifically for a project. In these cases, costs eligible for capitalization are the actual borrowing costs incurred, regardless of how much expenditure has been incurred on that asset to date. So as soon as you're allowed to start capitalizing, which we'll cover in a second, all of your borrowing costs may be capitalized under specific. Just important to note here, I think we've got on the slide that the amount of borrowing costs that you can capitalize in the situation under IFRS will be reduced by any income earned on the temporary investment of such borrowings. So if you take out a huge loan specifically for a project and you start incurring a few costs up front and you start capitalizing costs or capitalizing borrowing costs, the standard says, sure, you can capitalize these specific borrowing costs, but if you put a large sum of that borrowing into a kind of money market account and you're earning interest income on that, you need to offset the amount that you're capitalizing with that income. All right, so then the general borrowing costs is essentially where borrowings are part of a general pool. So you have like a general facility that you use broadly for capital expenditure. In these cases, the eligible amount is determined by applying a capitalization rate to the actual expenditure on that asset. So very different to above. The capitalization rate is required to be calculated as the weighted average of the borrowing costs that are applicable to the general pool. So you might have a few different facilities that form your general pool of borrowings, and to determine how much you can capitalize, you multiply that kind of weighted average capitalization rate to the actual costs you've incurred on your project to date, and that's what you capitalize in those instances. Okay, next slide, please. I just included a couple examples here, which obviously everyone has access to the handouts. Definitely download these so you can refer to these in case you have this kind of scenario and want to refresh yourself. So we can skip ahead to slide 44, please. So now that we know what we can capitalize and for which assets, we need to understand when we can capitalize. That's the final kind of real key criteria here. So an entity should start capitalizing borrowing costs when the following three criteria are met. Firstly, expenditures must be incurred. So the entity has started to incur expenses on its qualifying asset, so the project has already begun. Secondly, borrowing costs have to be incurred as well. Of course, you're not going to capitalize something that hasn't been incurred. And finally, activities that are necessary to prepare the asset for its intended use or sale are in progress. So once you meet these 3 criteria, you start capitalizing borrowing costs. Then fast forward to the end of the project, an entity will cease capitalization when substantially all of the activities necessary to prepare the asset for its intended use or sale are complete. Again, there's some room for judgment in this area of when is substantially all, but usually if the asset is ready for use, that's a pretty strong indicator that capitalization should end. And then if for any period in between starting and ceasing capitalization, there's a period in which active development is interrupted, then capitalization should be suspended. And examples of this could be planned interruptions, like taking a few months off for severe winters like we have here in Chicago, or unplanned interruptions such as supply chain issues like we saw during COVID, for example. And we've included in the slide deck here a couple examples which do a really good job, I think, of illustrating the concepts we've just covered. And so I definitely encourage you again, please download the handouts, have a read through those, particularly if you're not crystal clear on the difference between specific and general borrowing costs. So yeah, I think we're going to skip ahead, Andy, now just very briefly to slide 51, which is where we have our US GAAP versus IFRS differences. So I just wanted to highlight that standards are mostly converged when it comes to the general principles. However, there is some divergence in the application. And I've included here a few of the areas where we see differences that we expect you to encounter most commonly in practice. Those are foreign exchange differences, which can be capitalized under IFRS, but usually aren't under US GAAP. Interest on operating leases, which under US GAAP, you cannot capitalize. However, under IFRS, you can. Remember, under IFRS, there is no operating versus financing leases for IFRS 16. The next one is equity method investments. So under US GAAP, there are situations where these might meet the criteria of a qualifying asset. However, under IFRS, they will never. So over there, you wouldn't under IFRS. And finally, investment income, which we kind of touched on earlier. Under US GAAP, typically you wouldn't offset that specific borrowing costs with the interest earned. However, under IFRS, like I mentioned, you would. And yeah, so that's it really. Like I said, short and sweet for IAS 23. And I think I'm going to hand back to Jeff to close us out.
Thank you very much, Shane. So that is the end of today's training. I want to once again thank our presenters for the informative discussion, and also Chartered Accountants Worldwide Network USA for providing the opportunity to present to all of you. So for anyone unfamiliar with Chartered Accountants Worldwide Network USA, we are a non-profit organization dedicated to supporting chartered accountants who reside in North America. And our mission is to facilitate your professional success. If you are a chartered accountant and you're not currently a member, please do sign up on our website and join our group on LinkedIn. Looking forward, our next webinar will be on October the 24th at noon Eastern, and it's part of our Beyond Accounting series and is about the do's and don'ts of networking. Finally, in relation to training, please remember to check out our website's e-learning portal, which includes an online ICEX prep class, as well as AICPA CPE courses. And with that, that's the end of today's webinar, and you may now exit. Thank you very much.